Today we're doing a video on banks again, and I want to know if JP Morgan or Bank of America is the better buy. I also want to look at Citigroup and US Bancorp because these are Warren Buffett holdings. So we have our income at about 100,000 a year and we want to get this up. And we already made a video about how bank stocks were looking cheap and we bought FAS as our triple leveraged finance play. It's a way for us to get the most bang for our buck. But FAS, as you can see here, we only have 1,000. FAS, we also got a sign on DPST, the triple long regional bank ETF. But neither of them have dividends. So what about Bank of America and Citigroup as a way to, and JP Morgan and US Bancorp, as a way to get 100% gain potential without the maintenance, the high maintenance that the triple leveraged ETFs have? DPST and FAS have 100% maintenance, so they suck up 100% equity. But Bank of America and some of these guys have 100% upside. See, Bank of America was at recently 37, but it was at 50 in 2022. And it's at 28 now. So that's almost 100% upside from 25 to 50. So we're going to buy a little Bank of America just because it's a Warren Buffett holding and it has a 3% dividend. Okay, it's also at its 200-day moving average on its chart, which we showed you in our past video. It looks like a really positive setup. So Bank of America, it's had its parabolic washout. Now it's come back to this new support level where it's going to be consolidating. Oversold on a 1 year. MACD is about to cross the blue through the orange. Lots of buying volume. So there is smart money here, and they must think that this bank is okay. Warren Buffett, again, is in this. So it's on the 200-day moving average as well on its max chart. So I'm going to buy some Bank of America right here, right now. Buy market, and we're going to do 1,000. 1, 2, 3. We're going to buy all these, by the way. We're going to put on our triple short again, FAZ, after we do all this. Bank of America, buy, place. So $1,000 worth. Okay, Bank of America is only 30% maintenance. Now let's go look at US Bancorp, or whichever order you want to pick. JP Morgan, fine. I like US Bancorp, though, because it has a bigger dividend than JP Morgan. It has a 5% dividend, unlike Bank of America's, which is 3. I think JP Morgan's is around 3. US Bancorp is 5. And on a max chart, it's cheap. Let's go zoom into it. This is also a Warren Buffett holding, US Bancorp. So, and we're not talking UBS, we're talking US Bancorp. See if I could show you, you could go look up Warren Buffett's portfolio, and it shows that, his holdings, and this is one of them. So we broke through the 200-day moving average on US Bancorp, but we're at the 2020 Corona low almost of 30. And it also has 100% upside. 60 was its highs, and it's at about 34 now. So I'm going to go ahead and add to this one right now. And it's down in the pre-market, so I'm using this as an opportunity to buy on weakness. So US Bancorp, we're going to do, we'll do 1,000. 1,000, because again, it has a nice dividend. It covers my margin. Buy US Bancorp, 1,000 place. Okay, so I have 300K on in margin, and I don't want to add any more to my margin than I have to, but these are top quality companies that are a big part of the S&P 500, so I'm going to get, I think, good allocation here to the financials and get good risk reward to the financials, and that should help performance in our portfolio going forward, assuming no more systemic issues happen with banks. We'll keep our eyes open for that. But 3% dividend for JP Morgan, as I said, it was at 140. Now it's currently at 130, so not much upside for JP Morgan. So I'm probably not going to buy this one. It hasn't even had a huge pullback. This is everyone's favorite. They think it's the highest quality. But it hasn't had a big enough pullback for me to get interested. So I'm not going to do JPM. Plus the dividend's not that good. Citigroup is our last one. The last one that I wanted to discuss. Citigroup, obviously it's way off its max highs because it restructured in 2008. But if we go look at it on a 1 year chart, we'll see that it has had a significant pullback. It was at 50. Now it's in the mid 40s, and that was a year ago. And 3 years ago, it was at 80. So, and I believe Warren Buffett came in around that time, around 70 to 80. maybe 60, and bought Citigroup. So we're definitely going to add to Citigroup here because it's a Warren Buffett holding. Again, it's in the S&P. It's top quality and has a 4.5% dividend, and it has a 100% gain if you go to get back to its highs. But again, it has only 100%. It has 30% maintenance. So we like 30% maintenance because we can pile on more margin, and it only sucks up 300 equity. So 100, if it's 30% maintenance on 1,000, only 300 equity is taken up. So Citigroup, buy, place. Okay, now these are done, and let's go. We have one more minute until the market opens. So let's just go see our purchasing power. We were just at 78-ish. Now we're at 77. So it didn't take up much purchasing power. Our margin will go up though from about 300, 290. It'll go up to about 294 when the market opens. It'll be about 294, and then we're going to add in our triple short just to get some protection. So we're going to buy FAZ. We took it off yesterday because we only had 1,000 in FAS. We got to sign the DPST. Silicon Valley Bank got the rest of its assets acquired. So I like the safety of financials over the weekend. I reduced my short. I took off my short, but now I'm going to add the short back in. We'll do 700 short. Okay. I wanted to do 5, but we'll do 7. Make it worthwhile. So 30 shares. So we're at 700. For a triple short, that's like having 7 times 3, 2,100 long. So it's like having 21 single shorts. So buy 30, place. Now the 3 banks that we bought today, the 3,000 that we bought, and Citigroup, Bank of America, and USB, that is now pretty much hedged by this FAZ purchase. Now FAS is still our other financial and DPST, but I'm not going to buy it. I'm not going to do anything with DPST. I want to buy the holdings within DPST, but like DPST, these holdings are 100% maintenance. So the market open, let's see, we have 293 in margin, okay? So now let's go look at Key Corp, which is a regional bank that I really like because it has a 7% dividend, almost 7%, 657 on the dividend. Sorry about the background noise. The trash man is coming. So Key Corp, okay, it was at 20. Now it's at 12. And that was just this year. And then you look at it on a full time frame, it was at 25. So this has 100% upside and a 6.5% dividend. So if you guys like that, okay, I would buy that. I like that too. But I'm not sure about this regional bank. I don't know how safe regional banks are. But the big deterrent, I would go ahead and buy it just because it's been such a quality company for such a long time. I would buy it here. But the reason why I don't buy it is because of the maintenance. Go look at maintenance trading. Let's go back to our account, and I'll show you the margin tab, which shows you our maintenance levels. So we're down 1,500 to start the day, down 0.24. What's the market down? The Nasdaq's down 0.32, S&P is down 0.26, and then Dow's down 0.11. So we're down 1,500, but we're down in line with the market. That's all that matters. Okay, so let's show you this margin tab. Margin, and this will show you how much equity each one of your stocks takes up. So let's look at Key Corp. Again, I really liked it. I was going to buy this last night, but when I saw that the maintenance is 100% long, see, 100%. When I saw that was the case for Key, I can't buy it because, $1,000 is sucked up by the 100% maintenance. So if it takes up all of my equity. This available withdrawal would go from 77 roughly to 76 if I bought Key Corp. But if I buy 1,000 of Citigroup, only $300 is taken up. Plus Citigroup and these large cap banks are higher quality. So here are the positions in the portfolio. They're here. They should be here near the bottom because I put all my small positions at 1,000, as you can see by this column. So we have 1,000 Citigroup, 1,000 in Bank of America, and 1,000 in U.S. Bank Corp. So we also have FAS, we have FAZ, the short, to counteract FAS, and it's decay. And then we have DPST. We would buy a short for DPST, but there is no short for DPST. So I'm just going to let this go because it's kind of like a lottery ticket on regional banks coming back. DPST is a terrible investment. It decays badly. The only reason why I had it is because I sold options on it. I like to sell options on these bottom lots here. At the bottom of the portfolio, I sell options to, I try to get all the 10 sectors in the options so I can replicate a small portfolio within the portfolio, a diversified portfolio that resembles the S&P. So I wanted to sell puts on financials, but I don't like selling puts on stocks because that could be unlimited risk and you never know if a stock will come back. So I like to sell puts on the indexes. But I wanted regional banks and there was no other way to really sell the puts for attractive premiums. So I sold them on DPST. Again, terrible asset. I'm only using it as a vehicle to sell options on. And then I got a sign on DPST. So I'm just going to let that go again because we got a sign near perhaps the ultimate bottom in regional banks. So I'm going to use this opportunity to take the premium I received in DPST. I got a loss as I assigned it, but I haven't sold the loss. It's unrealized. And this $750 could turn into something, you know, spectacular if we got 100% rally. But if we got 100% rally, we could see a 300% rally in DPST. Let's just go look at a chart of it really fast. DPST, it's at 7. It was just at 30. So we can make it back to anywhere close near 30, even with the decay. That'd be almost a 200% return, and 700 could turn to 14 and then 14 to 28. So it could, but yet we only lose 700 if it, you know, goes to zero, which it won't. We lose something like 300. So if it just were to fall by half this amount. So I really see little risk in DPST at this point, and it's just all reward for me. But I'm not going to sit here and, bank my investment strategy on DPST. I'd rather go with these dividend plays like Bank of America, U.S. Bank Corp, and Citigroup, because that's the name of the game at this channel. We use the margin, 300,000 approximately we have in margin, and we use the dividends to pay back that margin. So estimated income should have grown now just by a small amount. We're at 100 and something now. We're at 101.93 because of those 3 banks that we bought. They have, you know, the dividends, 5% about for all of them. So 3 to 5%. So performance and value, let's just check that out before we head out here. Performance, we're up 7% versus the S&P is up 3 and the Nasdaq's up 11. So right in the middle, just as always. This is where we like to keep it. So I said in the last video, even if these banks fail, if they keep the dividends, then over time the dividends cash flow the investment. 5% dividend means that in 20 years, which is a long time, I know, but in 20 years the dividend pays for itself. And so the investment pays for itself and your risk is gone because now you're playing on house money. And people think 20 years is a long time, but don't you want to have a long-term investment horizon when you're young? Like I'm in my 30s, but anyone should really have a long-term investment horizon. Traders lose 90% of the time statistically. So 20-year time frame is realistic. When your retirement's around 80, 20 years is not even a long time. So we're thinking long-term. The dividends pay back all of these assets. And our higher dividend yielding plays, Cornerstone, JPM, and all these, they have 20% dividends and between 10 and 20% dividends, so the payback period is less. It's between 5 and 10 years for these other index funds where we get a majority of our dividends from. So the banks will be a nice boost to our income level, a modest amount, but it should help us in capital gains as these stocks rally back to their previous highs. That should help performance in the portfolio. Not so much with the income, it helps modestly, but should actually help performance from here. So, and we have the short to protect ourselves. So anyway, I hope you like the video. Let me know if you have any other suggestions on which banks would be a better buy at this time. Hey, I wanted to say one more thing. A lot of the bears are saying that they like the banks here, but how could the banks be a good buy when there's a recession coming? They think, well, there's only 10% downside left in the banks, so why not buy now? I feel the same about the market itself. And then some of these bears, even like Amazon right now, well, they're just liking bellwether plays now that are the market. So if they're in these stocks and they think that they will stay up while the rest of the market falls, they're mistaken, because a rising tide raises all ships and lowers all ships. So I just wanted to throw that last point in there about how people are bearish on the economy and on the stock market, but they're buying banks and they're buying tech, they're buying Amazon. Steve Weiss also said he even liked Deere, which is just funny because that's an industrial. So now you're just picking the market itself. You're just getting diversified into the 10 sectors and saying these are my favorite picks, but the rest of the market won't go down with it. That's an absurd argument, and so that's why I'm buying, because these guys even see attractive assets. And when you come down to it and you try to look at other attractive bargains in the S&P, not just Amazon, but let's say a Salesforce, you start finding that there are more and more that you want to buy, and it comes out to about 500 of these things. That's why it's the S&P 500, and you can't buy them all, so just buy the indexes, which pay the dividends, and they beat the stock dividends any day. So, and they give you the safety of an index, the protection of a basket of stocks versus stocks themselves, which have headline risk. So that I just wanted to add that point in. Thank you very much, guys. Talk to you soon.